Welcome to our deep dive into capital gains tax, or CGT, covering Part 8 of the tax guide. While we often refer to it as a separate tax, the net capital gain made by a taxpayer in the income year is actually included in their assessable income and taxed at their marginal rate. It's vital to note that CGT generally applies to assets acquired on or after the 20th of September 1985. Today, we will explore everything from asset identification to complex calculations and specific rules regarding shares and property. Let's look at the baseline rules. For Australian residents, CGT is a global affair, applying to assets worldwide. For foreign or temporary residents, it's restricted to taxable Australian property, like real estate. A critical rule to remember and explain to clients is that capital losses can never offset ordinary income. Like their wages, they can only be used to offset capital gains. If a client has excess losses, they carry forward indefinitely until they can be utilized. On the tax return, item 18H captures the total gains before any adjustments, while 18A represents the final net gain added to assessable income. Ownership structure dictates how a gain or loss is distributed. Joint tenants split the tax outcome equally, whereas tenants in common split it strictly according to their legally documented ownership share. For partnerships, the CGT event flows through to the individual partners. So, what exactly is a CGT asset? It is very broad, ranging from physical real estate and shares to intangible items like contractual rights, goodwill, and cryptocurrency. We categorize assets into three distinct buckets because they have different tax treatments. Collectibles are personal enjoyment items like artwork and antiques. If your client bought a painting for $500 or less, it's exempt from CGT. Furthermore, a loss on a collectible can only offset a gain from another collectible. Personal use assets include boats and furniture. These are exempt if acquired for $10,000 or less, and importantly, any losses on these assets are completely disregarded. The other assets category captures everything else, like shares and investment properties, which are subject to standard CGT rules. Not every asset disposal triggers CGT. The most common exemption you will encounter is the main residence exemption, though this has specific conditions we assess carefully. Other notable exemptions include assets purchased before September 20, 1985, personal cars and motorcycles, gambling winnings, and compensation payouts for personal injury. Also, if an asset is considered trading stock, for example, if the client is a property developer or share trader, the transaction is treated as ordinary income, not under the CGT regime. Timing is absolutely critical in CGT calculations. It determines eligibility for the CGT discount and cost-based rules. For real estate and most assets, the acquisition and disposal dates are the dates the contracts are signed, not the settlement dates. For example, if a client signs a contract to sell land in June 2025, but it settles in October 2025, the CGT event falls in the 2025 tax year. If an asset is destroyed, the CGT event happens when the insurance compensation is first received. When an asset is sold, a capital gain arises if the capital proceeds exceed the cost base. There are three calculation methods. If the client has held the asset for less than 12 months, and we count this precisely as at least 365 days excluding the acquisition and disposal dates, they must use the other method, which simply subtracts the cost base from the proceeds. If they have held it longer, we can use the discount method, or, if purchased before September 21, 1999, the indexation method. For assets held over 12 months, the discount method is incredibly valuable, effectively cutting the taxable gain in half for individuals. Crucially, any capital losses must be applied to the gain before you halve it. There is also a bonus discount of up to 10% available for properties used for affordable housing for at least 3 years. Alternatively, for older assets bought before late 1999, you can index the cost base for inflation up to September 1999. Software usually calculates both, allowing you to choose the method that yields the lowest taxable capital gain. To calculate a capital loss, we use a slightly different figure called the reduced cost base, which we will define shortly. If the capital proceeds are less than this reduced cost base, the client has a capital loss. You do not index or discount a loss. When applying a capital loss against multiple capital gains, order matters. Always apply losses to other method gains first, as these are taxed at full value. You want to apply losses to discounted gains last, because doing so eats up the loss with a gain that was already going to be halved. Capital proceeds represent the money or value of property received. If a client gives an asset away as a gift, or sells it to a family member for a dramatically reduced price, the ATO requires us to substitute the true market value as the capital proceeds. Market value should ideally be determined by a qualified professional, like a registered valuer. We also look out for CGT event B1, which occurs in rent-to-own or hire purchase agreements. The CGT event triggers when the entity first obtains use of the asset, not years later when the title transfers. The cost base is built from 5 distinct elements. The first is the purchase price. The second includes incidentals like stamp duty and broker fees. The third element consists of ongoing ownership costs, like interest and rates, but only for assets bought after August 20, 1991. The fourth element covers capital improvements, like building a retaining wall. The fifth covers costs to defend the title. The absolute golden rule here is double dipping is prohibited. If an expense was claimed or could be claimed as a regular tax deduction against income, it is stripped out of the cost base. To figure out if a client made a loss, we look at the reduced cost base. The main difference here is that you cannot include those third element ownership costs, like mortgage interest or rates, in a reduced cost base to inflate a capital loss. Because the reduced cost base is lower than the regular cost base, you can have a scenario where the sale proceeds fall exactly between the two numbers. When this happens, the taxpayer records neither a capital gain nor a capital loss. Additionally, you can never include illegal expenses, bribes, or non-deductible rental travel in any cost base. Moving to shares, the core principle is that every single batch or parcel of shares purchased is treated as a separate asset. When a client sells part of their portfolio, they can choose exactly which shares they are selling to optimize their tax outcome. They can use first in, first out, or specifically identify the parcel. Average costing is rarely accepted by the ATO unless strict conditions apply. If a client sells multiple parcels at once, the sale brokerage fee must be proportionally divided across the different parcels based on the number of shares. Dividend reinvestment plans are very common. For tax, it's treated exactly as if the client got the cash and bought new shares. This means the dividend is ordinary income in that year, and a new CGT asset is created with a new acquisition date. Bonus shares, however, operate differently. Issued after July 1998, they aren't usually taxed as dividends. Instead, they take on the acquisition date of the original shares, and the original cost base is simply diluted across the new total number of shares, lowering the cost base per share. Corporate actions trigger specific CGT events. Under Event G1, if a company issues a return of capital, this isn't income, rather, it directly reduces the client's cost base. If the company goes bankrupt, Event G3 allows the client to crystallize a capital loss once the liquidator provides a written declaration of worthlessness. We also handle takeovers and mergers. If a client exchanges shares for shares in a takeover, they can often use scrip for scrip rollover to defer the capital gain. And in demergers, like the Wesfarmers Coles split, the original cost base is apportioned between the old and new shares. Finally, let's look at how building cost write-offs, or capital works deductions, impact CGT. If your client claims these deductions over the years, they can't double dip when they sell the property. For a capital loss, you must always subtract the claimed amounts from the reduced cost base, shrinking the loss. For a capital gain, you deduct it from the cost base, thereby increasing the taxable gain, but only if the property was bought after 7:30 p.m. on May 13, 1997. Beware, if a client was entitled to claim it but forgot, the ATO still requires you to reduce the cost base as if they had claimed it, unless the amendment period has expired. Thank you for watching, and don't forget to like and subscribe.